Hello everybody. Listen, when you look how the very wealthy, the millionaires invest, it's pretty easy. There are some studies out, and they all agree pretty much that the rich invest the boring, conservative, and long term, and they own like a third of. In a study was found out that a third owns ETFs, so like kind of index funds, and they invest in those index funds long term. And then they have a lot of blue chip companies like Johnson and Johnson, Apple, Exxon, Berkshire Hathaway, Coca-Cola, and so on. Exxon. And then they have cash, of course. They have real estate, and they have bonds. That's pretty much it. It's pretty much long term, and there's no trading or knockout products or options or short term thinking. It's just long term basic stuff, and with a long term perspective, it's just like boring. And pretty much the blue chips, they contribute a lot of dividends, and that's the recipe for a successful investment. And when you look at the retail, the middle class, there are a lot of people, they trade, and there's a study done by Dalbar. They researched how people did do over a period like of 20 years their performance of fund investors. So the fund investor technically buys on the high and sells on the low, so it's always wrong. They buy up here and sell down here. It's emotionally based, and it's a big problem. So the average return of that investor of retail of the middle class kind of is 2.5% annualized, and in the same time the S&P 500 index would have made like 9.9%. That's what Dalbar, the research institute, found out. And so the gap is between 2.5 and 9.9 is a lot, and you miss out if you like invest like, let's say, $10,000 for, you start with $10,000, you invested for 40 years, and the average guy makes like out of the 10,000, like after 40 years, like 30,000 or so, 20 or 30,000. And so the other one who would just put the money into an index fund, like let's say the S&P 500, you assume it would still perform like 9.9% average return over 40 years. You would have like 400 some thousand dollars. So there's a huge difference, a difference of 400,000. That guy who trades and goes emotionally crazy, who buys high and sells low, kind of just makes back the inflation. So it's pretty much neutral, the money, even though you let it sit there for 40 years and work with it. And the other one who just sits down and puts the 10,000 into an index fund and just lets it rest, goes into, makes out of it 400 some thousand. That's a huge difference, and has a return of almost 10%. Okay, that's all for today. Bye.